Today I'm going to talk about how to build and balance your three pools of money. As an entrepreneur or owning your own business, there's a lot of issues going on all the time with finances, and it's critical that you learn how to build and balance your three pools of money. So what happens is most people have all their personal investments, assets, insurance, and it's kind of like in there all mixed around. They might have IRAs, they might have life insurance, they might have all these things. And then now you have a business. So if you're self-employed or own a business, you have maybe partners, buy-sell agreements, maybe bank accounts, retirement accounts, and all kinds of contingencies. And what happens is without a real model, things are totally uncoordinated. As you can see, they're not integrated. Maybe you bought some financial products on opinion of your neighbor, a friend. And what happens is it's very uncoordinated, and it can lead to confusion and being out of control. So one of the things we strongly recommend is mapping things out with a model, both on the personal side and on the business side. And here you have, this is a protection, savings, and growth model where you can see everything mapped out on one page. And as you go through life and as you go through years in business, it's really critical to have this organized so you can see what's integrated, what's not. And what your financial world looks like. Most people lack the ability to see their financial world on one page, especially with a business. So this is the beginning. The next most important part is how do you build wealth? And I talked about these three pools of money, which I'll go into in a couple of minutes. First, most people have some kind of IRA, a SEP, a defined benefit plan, a 401k. Everyone knows about 401ks. But we have this qualified retirement plan scorecard to see, is your plan really helping you enough? Is your plan all it could be and all you want it to be? So I invite you to check out this scorecard. It takes all of 90 seconds. And basically what it is, it's trying to see how your plan stacks up. Is this working for you? So the first question is design. Is your current retirement plan design meeting all your objectives? Are you maximizing your tax deductions? Are you building enough personal wealth for your retirement, and are you providing any kind of incentive for key employees? So the way you do the scorecard is you read each statement and you score yourself 1 to 5. 5 is the best, your plan is awesome, 1 not so good, and then everything in between. You do that for fees and fiduciary protection. We live in a world today that is very litigious, and quite frankly, so many of the retirement plans we view do not have the right level of fiduciary protection, and you are exposed. So you're going to read that, education, on-site meetings, performance, service, and overall satisfaction. So this scorecard, again, will take you about 90 seconds. You'll add them up, and here's what your score means. If your score is on the lower half or even lower 2/3, you should get a second opinion. So this is building qualified retirement plan assets, which is one of the three pools. Very important to get this done. I don't know if any of you have seen the show 24 when it was out with Jack Bauer about counterterrorism. Well, on that show, I used to love the show. In the beginning, they had a disclaimer that said what you are about to see could upset you. That's this slide. This is the history of the top U.S. marginal tax bracket in this country. From 1913, the beginning of the end, that's when income tax rates started, up until now. Believe it or not, the top average bracket was 57.62%. So here's where the top bracket is now. So one of the issues is, as you're building wealth and you're building your three pools, most people are building money for later, right? To build wealth for retirement. So I could take it out, have a nice life, not have to work, and enjoy my life. Well, if you're in your 30s or 40s or even 50s, and you're looking at where the brackets are now, where do you think they're going to go? It is very likely that they go back up. Even though we don't want them to, even though we all feel like we pay way too much in tax, government doesn't really care. They care about balancing their books, which, by the way, they're not so good at doing. It's very likely tax rates are going to be higher. I don't know if any of you remember the great book by Stephen Covey, The 7 Habits of Highly Effective People. What he said in that book was you begin with the end in mind. Makes sense. You're only building wealth to use it. So my caveat on those great retirement plans is that we have to balance this because it's possible you're putting money away at 33 or 35, or the top bracket is now 37%, to maybe take it out at 60. So I'm not saying it's going to be 60. We don't know where it's going to be. You want to be prepared. So this is a big, big deal. And at this point, I guess I'll apologize if I've upset you, but the goal is to be prepared for what the realities might be, right? That's part of our job, is proactivity, being ahead of the curve and helping our clients build wealth so that they're ahead of the curve, so they have a great life later. So let's talk about the three pools of money now that I've given you that introduction. The first pool is qualified assets, which are IRAs, pensions, 401ks. The second pool of money is regular non-qualified investments. So it could be your stock portfolio, bonds, mutual funds, CDs, treasuries. And the third pool is Roth IRAs and life insurance cash value. So if you get to retirement and you have $1 million in pension, IRA, 401k, and you went to take all that money, you wouldn't get $1 million because the government, who's your partner, would want a piece. Now, when you're doing it initially, I have Euphoria here. If you put $100,000 in a retirement plan and you save 40% in combined federal and state taxes, you're saving $40,000 in taxes, which is huge. So it could be Euphoria for you, which is awesome. But the issue is, if you go to take this $1 million here, you're going to owe $400,000 of taxes if your combined bracket is 40%. That's not Euphoria, but it is what it is. But just be aware that $1 million in a retirement plan is not $1 million of cash for you. You have a partner called the IRS. Pool 2, if you had $1 million, you're going to have some ordinary income, which would be at 40%, and some long-term capital gains. So between federal and state and potentially local, you could be in a 30% tax situation there. And the last pool, if you happen to have at retirement $1 million in Roth IRAs or life insurance cash values, it grew tax deferred and it can be distributed tax free if you do it correctly. So these are your three pools. So assume you're 65 or 70 years old and you're at retirement and you have these $1 million in each of these three pools. What do? Do you spend a little from each? Do you spend down one and the other? These particular assets, if you're in cash value of life insurance, you're going to have pain initially because you put in money and in the beginning years the rate of return is low and you don't accumulate so much. So you will have a little pain here in the beginning. If I let pool 1 double from $1 million to $2 million while I spent other assets, that's great, but I also doubled my tax. See, I doubled my $1 million to $2 million, but I doubled my tax from $400 to $800. So that's not great. You know, you go in retirement and you pay taxes, it's very painful. Because when I'm working and I'm paying taxes, it's painful, but after April 15th, I go back to work the next day and I'm making money to hopefully replace what I just gave to the IRS. When I'm retired paying tax, I'm hoping to not have to go back to work. So it's very, very painful paying taxes in retirement. Pool 2, if we let pool 2 double, we added approximately $300,000 of taxes, and every year it's going to be different and everyone's tax situation is different, so you must consult with your tax advisor. However, that being said, if I had my choice of these two pools, I would spend pool number 1 first and let pool number 2 double, because by doing that in this example, I saved $100,000 of taxes. I could spend the heavier taxed item first, let the less taxed item double in value, and then spend it, and I benefit by paying less tax. 3 is tax-free. So it's tax deferred, and then you could take it out tax-free, and you could take out money with no tax. In fact, as I mentioned, being retired and taking out money tax-free is euphoria. Can you imagine being on the beach and taking all this income and paying 0 tax? That's a pretty good feeling. So the goal is you have to balance these pools, very importantly. Pool 1 represents euphoria out of the gate, putting in money, getting a deduction, feeling great the year you do that. But it also represents pain in retirement. The old adage that you'll be in a lower tax bracket in retirement might have been true way back when. It's not true so more now. Pool 3 is interesting because it's pain out of the gate, it's slow out of the gate, but the end game is unbelievable. The end game is euphoria, it's tax-free. And Pool 2 is great because it provides liquidity, flexibility, cash flow, maybe buying real estate and doing different things. So the goal is to have a good balance. So if you knew all of this out of the gate, when you started your career and started making money and saving money, the goal is to get the longest compounding curve out of the stuff that's taxed the least. And then you're going to do other things like 401ks and profit sharing and defined benefit plans and build other liquid assets and portfolio assets and investments. But the key is to have a balance. Have a balance so you can manage growth, liquidity, and most importantly, taxes. Taxes are very important to be able to manage. So what are the risks? We face so many risks in retirement. Longevity risk, living too long. Listen, medicine and technology is getting better. They're going to keep us alive more, but will we have money? Market risk, principal loss. You get older, you really don't want the risk with your money, right? We have clients that are well into their late 80s, and their check comes every month into their checking account. They don't want risk. Interest rate risk, inflation. Inflation's a huge deal that no one's really focusing about. It's going to be a big deal. Higher income taxes, we talked about that, and public policy risks. I don't even want to get into the public policy risks. There are a million of them out there right now. Sequence of return risk. How the stock market returns risk on accumulation mode does not really hurt you so much as compared to distribution mode. When you're taking money out in retirement and the market is down, it kills your accumulation. Needing more money to live on than you thought, I mean, that's a given. I mean, everything costs more money, and what it is more things are going to be created that people are going to want, and they're going to spend money. My parents probably never thought they'd be buying wireless routers and cell phones and spending money on that stuff. Children and parents need unexpected financial assistance. Yeah, parents need help, children need help. Excessive pride, hubris. Some people are so in the mode of I know it all, and they don't. And that could financially be devastating. Being disabled before you have a chance to build enough wealth, forced retirement, reemployment risk, prolonged illness, health expenses, long-term care. There's a whole lot of things here that are risks. So what do you want? Ideally, the goals in retirement: stability, predictability, tax-free income. Definitely want less taxes. Contingency plans. You need wiggle room. Things change. One thing about life is it's not a straight line, and all those mountain charts you've seen from financial people, there are all kinds of curveballs that come at us, and you got to be able to deal with them. Capacity to create leverage. There's some really good tools for exit strategies with real estate and other investments to pay less tax. Ease of use. You get to retirement after all your years of working, all your years of stress. You want it easy. Creditor protection. Getting tax benefits is key. No stress or financial worries, and financial flexibility. All what you want in retirement. So you got to begin to build it the right way now so you can have this. I like to say it's not necessarily about how much money you have, but what types of assets you have and how you can most effectively use them. That's the key. Interestingly enough, there was an article in the Harvard Business Review that was called The Crisis in Retirement Planning. And it says, our approach to saving is all wrong. We need to think about monthly income, not net worth. It's not about dollars on a scorecard. It's about money that you have that can produce cash flow, flows of income in retirement with less risk, less taxes, more flexibility, and all of that leads to more enjoyment and a happier retirement. And that's what it's all about. Thank you very much for tuning in. I did want to mention a lot of this information can be found in my book, The Entrepreneur's Guide to Achieving Financial Freedom. It's a great book. I mean, I wrote it, but it's a great book. A lot of information, about an hour and a half read. Email us, call us, we'll get you a copy. And if you want to discuss any of this, feel free to reach out. Thanks again. Have a great day.